every project needs a budget. But you're a project manager, not an accountant. Most project managers find the process of creating their first project budget somewhat daunting. So here then is my process for creating a project budget. We're going to look at 3 processes for creating a project budget, and the first is based on the way that you would create an operational budget. It is perhaps the simplest of these approaches and lends itself well to a template approach. What I mean by this is that we start with a list of cost centres or heads of expenditure, and then we fill in the individual costs within each. Number 1, activity or cost centre budgeting. This is a simple approach that works well in 3 main circumstances. Monthly budgets for a long-running project. That is a quasi-operational sort of budget. A basic budget for a simple project, where detail and rigour are not your top priority. An outline or indicative budget for a larger project, perhaps for an early stage of an outline business case. This would be a first-pass budget that would feed into a later, more rigorous budget. The way that we create this is we start with a series of headings for all the main areas of project expenditure that we anticipate. Things like equipment, personnel, rentals and leases, materials, licenses, those sorts of things. Perhaps you might have consultancy fees or other professional fees like lawyers or architects. Once you've got down the headings for those, you can put estimates against each one. For some of these headings, there will be a range of different expenses that you might anticipate. It's very easy to build a template for this and to adapt it to each different project. This is not a rigorous approach, but it does work well, particularly for simple projects. Number 2, the work breakdown structure approach. This, on the other hand, is the most rigorous, most robust and most reliable approach for creating a project budget. If your project is important and it's important to you to have a rigorous budget, then start with your work breakdown structure. From that, you will create a cost breakdown structure. Simply put, you will allocate costs to each item in your work breakdown structure to build up a budget. The first step in the process is scoping. Determine what your project will do and create in scope items, and also what your project will not do and will not create, the exclusions from scope. And then get that statement signed off. Step 2, create your work breakdown structure. From your scope statement, develop a full work breakdown structure. I'm not going to go into how to do that here, because we have a full video on how to create a work breakdown structure, and I'll put a link to it in the description. Step 3, estimate costs to create a cost breakdown structure, or CBS. For each element of the bottom tier of your work breakdown structure, make an estimate for all of the costs involved in either doing that work or creating that product. This includes the time and the cost of the work that people are doing, the cost of materials or consumables they might be using, and the costs of assets or equipment that they also need to use. This might include things like licensing. In doing this, you may need to combine unit costs like cost per hour of consultants or cost per item of consumables with estimates of how much you're going to need. So this is very closely related to the process of schedule estimating, because if you need to know how many hours someone is going to work for your schedule, you're also going to need that for your cost estimate too. Once again, I have a video this time about estimating project costs, and again, I'll put a link to it in the description. Step 4 is to aggregate your costs into a project budget. Now that you have a full cost breakdown structure, you can take all of the costs that you've estimated and draw them together into your budget. conveniently, because you've based your cost breakdown structure on a work breakdown structure, when you import this to create a budget, it will be structured in a highly logical way. Broadly, there are two approaches for how you're going to be doing this. The first will be if you have some form of highly integrated project management software or project management information system available to you. If this is the case, then chances are it's just a flick of a switch, a press of a button, because you'll have entered all of the data and the software will have a way of taking it from the work breakdown structure format into a consolidated project budget. It's also worth knowing that many ERP, enterprise resource planning software tools like Oracle or SAP also have project budgeting modules which work from a work or cost breakdown structure approach. However, the second approach is if you are relying on simpler tools. In this case, frankly, a spreadsheet is your best friend here. Starting with your work breakdown structure dictionary, which should now have costs allocated to each item in it, you can then convert those into a spreadsheet. Indeed, many people create their work breakdown structure dictionary using a spreadsheet, so you're already likely to be there. You just need to do some formatting and laying out to make sure you can consolidate all of this into a project budget. RACI chart approach, or linear responsibility chart approach. The terms RACI chart and linear responsibility chart have converged. There was a time when they referred to two slightly different but consistent tools. Nowadays, most people refer to what I learned to call a linear responsibility chart as a RACI chart, and I don't need to go into the details of this. Suffice to say, I already have a video on describing how to create a RACI chart. Yes, I'll put a link in the description. We use RACI charts as the basis for creating project budgets, particularly for simpler projects, and also for projects where the primary set of costs are connected to people's time, the cost of your resources. Yes, you can use RACI charts for project budgets where there are other resources aside from people's time, but typically it's organisations like consultancies and professional services firms that use RACI charts for budgeting. Another good reason for using a RACI chart is it's extremely flexible in the level of detail that you apply. You can use RACI charts for budgeting at the level of major components of the projects like work streams, or down to smaller work packages, or if you choose, down to the detail of individual activities or tasks. The outcome will be a simple table with the tasks, work packages or work streams down the side and a list of all of the resources across the top. At the intersections of that table will be the cost estimates for applying each resource to each task, work package or work stream. Step 1 is to build your RACI chart or linear responsibility chart format. Draw a grid, and a spreadsheet is ideal for this. Down the vertical axis, list all of the tasks at the level of detail that interests you, either the individual task level or clustering them up into work packages or even into work streams. Across the horizontal axis, list all of the resources that are going to go into that project. Typically, I start with the human resources, the people, at the left of the chart, and then at the far right, that's where I'll put the materials, the consumables, and then the equipment and the assets. It doesn't matter how you lay it out, but it is a good idea to find a format that works for you and to stick to it. You can also do nice things like color coding or formatting it so that it is easy to read and easy to find what people are interested in. So if step 1 is to put all the tasks down the side and step 2 is to put all of the resources along the top, the next thing we need to do is under each resource, put the unit cost. For people, this may be an hourly rate or a daily rate. For consumables, it may be a per item or a volume rate. And for equipment, it may be a purchase rate or a hire rate or some other rate that allows you to calculate the cost. Finally, in the intersections, make estimates of the resource utilization. How many hours or how many days of each person's time is needed for each task, each activity, each work package? How many units of material or consumable do you need? How much time do you need to use from equipment and assets? Using the spreadsheet, a second cell can be used, therefore, to multiply the unit cost with the number of units to provide the cost estimate for that resource in that task. Because you've built it on a spreadsheet, it is then very easy to calculate the totals. The total cost for each person, the total cost for each resource or material, and indeed you can also calculate the totals across the chart to calculate the cost of each activity or work stream or work package. And of course, down at the bottom right, there can be a grand total, the whole cost for the project. Whichever of these three approaches you use, there are a couple of additional things to bear in mind. The first of these is whole project costs. There are often going to be some costs which apply to the whole project. They don't easily divide up amongst the resources or amongst the tasks or the work streams or the heads of expenditure. These are things like project management time, licenses for software that you need, or rental of accommodation for your project team. Maybe there will be insurances or financing costs like interest or exchange rates. Now, if you use the work breakdown structure approach, or any of these approaches really, I do favour having a heading for project management so that you include all of the project management costs in your base model. But any costs that you didn't include, any other whole project costs, need to get added on at the end. Whether you choose to allocate them to the different activities or work streams is up to you. My advice is it's probably not worth doing it because there's a whole load of heartache about deciding how to allocate them for very little real benefit. But in some organisations, it will be necessary. The second thing to consider is contingency, because things will go wrong. And if you don't have any contingency in your budget, then the first thing that goes wrong will cause you to go over budget. There are broadly 4 approaches to creating project contingency budget. And the first and simplest is to add one big chunk of contingency cash to the whole project. This is usually a simple figure, either one number of dollars or pounds or euro or yen or whatever your currency is, or more typically, a simple percentage applied to the whole project budget. The only times you're likely to use this approach, however, is with smaller, simpler projects. It has the merit of simplicity, but it is rather crude. Next is the simplest approach that really makes sense in anything but the smallest project, which is to do the same at a single contingency sum, but to each work stream. Each work stream is likely to have a different characteristic. It's going to involve perhaps different balances of different resources and have significantly different risks, so it makes sense to allocate a different percentage of contingency to each work stream in principle. Think about the different things that can go wrong for each work stream and also the confidence you have around the base estimates that you've used. So, while one work stream may have a contingency as low as 10%, another might need a contingency as high as 40 or 50% on the budget. The third approach, at the opposite extreme, is to add contingency to every single cost you estimate. If you think in terms of the work breakdown structure approach, this is taking every item at the bottom of the work breakdown structure and not just estimating a cost, but estimating a contingency on that cost, and then carrying that up through the work breakdown structure into your full budget. This has the merit, of course, of precision. But precision is not the same as accuracy. It creates an awful lot of work and may not produce a better result than a simpler approach. So the fourth approach is what one might call a common sense balanced approach. To decide where in the hierarchy of your work breakdown structure is the right place to apply contingency. Typically, this is where you can expect to see significant differences in either your understanding of the project, or the novelty of what you're doing, or the risk that you can expect from that set of activities. Estimate your contingency here and then carry it up to workstream level, or indeed, finally, to the project level. So there we have 3 different ways that you can create a project budget, and the 2 important things you need to make sure you add on to every budget. Project budgeting is not intuitive to many new project managers, but it is also not difficult in concept. The challenge, of course, is not putting together the budget, but making reliable estimates, which means understanding your project in depth. But the good news is, that is our core competence as project managers. Project finances aren't anybody's favourite topic unless you're a finance director. And estimating is one of the greatest challenges anybody faces in a project environment, because we are assailed by biases and in an environment of uncertainty. But we're going to tackle it anyway, because in this video, I'm going to look at how to estimate project costs. Before I start looking at how to make our estimates, I want to highlight one of the real problems we face as project managers and leaders. And that's what I call the estimating knife edge. The knife edge separates the 2 competing pressures we have to deal with whenever we're making estimates of cost or indeed of time. On the one side of the knife edge is the pressure, the pull even, from our clients, from our bosses, from our sponsors and from our stakeholders to minimise costs, or indeed to minimise the duration of a project to get it done as quickly and as cheaply as we possibly can. On the other side of the knife edge is the pull in the opposite direction, to include as much cost, as much contingency, as much time as we possibly can to reduce the risk of cost or schedule overruns, to give us as project managers the best possible chance of delivering what we've promised, when we promised it, and to the budget that we committed. And you are always going to be walking along that knife edge, trying to balance those 2 competing pulls. The process of project cost estimation needs to start with understanding the scope of the work you need to do, and the tool for that is a work breakdown structure. Once you have your work breakdown structure, you can estimate the time it will take to deliver each component of work. And from that, you can allocate people into the roles to do the work, and when you combine the time it will take with the cost of each of those resources, that starts to build up a cost estimate for the work that it will take. But there are other resources as well. And for each piece of work, you can also overlay the materials and the equipment and the assets that you need to do that piece of work, and to put in place cost estimates from those. The fundamental tool for building a cost estimate is a work breakdown structure, which you convert into a cost breakdown structure. So what are likely to be the sources of cost that we need to build into our estimates? Well, for many projects, the single largest cost is people. And these are your staff, your contractors, and your consultants. Each will come with a different methodology for calculating it, and bear in mind that some organisations do not account for the cost of their own staff, seeing them as a completely sunk cost. As a project manager, even if my client organisation doesn't wish to account for the cost of its staff, I always like to calculate it to give a true picture of how much the project is costing them. Next are real estate assets, property, facilities, offices, warehousing. All of these costs are large. And there are other assets besides property. And in estimating these, you may need to treat them as capital costs, or you may be able to treat them as revenue costs if you're going to lease or hire them in some way. Then we've got non-capital costs, revenue costs, things like materials and components. We've also got licenses, because a large part of many projects now involves software which needs to be licensed, whether it's the project management software tools or software that is part of the thing you're creating as a project. And finally, there are the financing costs, things like interest, foreign exchange, and insurances. So, what are some of the techniques that you can use to estimate? I'm going to offer you 6 basic estimating methods. And the first is an order of magnitude estimate. The idea of starting at the top and thinking about the big chunks and the approximate amounts that each of those are going to cost to produce a figure that is very round. If your project is going to be in the millions, then each of these sections may only be estimated to hundreds of thousands. If your project is going to be in the tens of thousands, then each of these components may be estimated to the nearest 1,000. Order of magnitude costs will give you a sense of how big your project is, and therefore some of the key elements of how much detail you're going to need to satisfy your client, your boss, your sponsor. The next method is to look at past projects and similar examples, technically known as reference class forecasting. You're forecasting or estimating the costs based on known examples that are comparable. But even when you do find comparable examples from the past, look at where there will be systematic variations between the past example and your present example. And of course, the most obvious one is cost inflation. If something cost $100,000 10 years ago, there's a good chance it's going to cost $150,000 today. The next method is called parametric forecasting, what I like to call rule of thumb forecasting. If we know that one worker can lay 100 bricks an hour, then if we know we need to lay 200,000 bricks, we can work out how many hours of work. And if we know we're going to fit it within a certain amount of time, that tells us how many people we're going to need. And if we know the daily rate of an average bricklayer, we've got all the data we need to make the calculation of the time cost. So parametric forecasting takes key numbers and multiplies them and adds them in a logical, mathematical way. The next method is to ask for bids or tenders to find out how much people are prepared to do the work for, and to use that as the basis of your estimate. Now, one would think that if you get a firm tender, that will give you the firm cost, but not all bids are based on fixed cost, and so you're going to need to build in some assumptions. And of course, there may be contract variations along the way, so you'll need to pack contingency into any estimates, even if you've got a fixed price bid. The next is catalogues and pricing tables. These are great working with your parametric forecasting methods. If you can draw down comparable data from published catalogues, from published pricing tables, you've got a great resource for building up your estimates. And finally, a great way to get really good data is to build a sample or a test or a pilot or a prototype. You can calculate the actual cost of doing that and use that as an input into your estimate for the bigger full production version. And of course, the secret to good estimating is to combine as many of these techniques as you can. And if you build an estimate, but it really matters how robust that estimate is, what about using a red team to either tear your estimate apart and look for faults, or better yet, to build their own parallel estimate and compare the two done in different ways by different minds with different approaches. You'll learn a lot by finding out why one team has done it one way and another has done it another way, and the first team got answer A, the second team got answer B. By comparing the two and understanding those differences, you'll be able to generate a better estimate. Always, always, always add contingency to your estimates. And my guidance is always not just to add one single contingency figure, but to look at the different work streams or the different functional components of your project or the different phases, and to look at the different levels of uncertainty associated with each of those based on their characteristics and what's in them. And therefore you may add 10% contingency to one work stream because it's fairly familiar, fairly well understood technology, but another work stream may be not using off-the-shelf components, maybe doing something we've not done before, and you may choose to put something like 40% contingency into that work stream. And when you combine all of those contingencies, then you'll get a robust project contingency. Finally, when you've got your estimates and you've got your contingency, it's time to build them into a cash flow. That way you can see how expenditure will flow out of your project and hopefully revenue into your project, if appropriate, over time. And if it's a long project and therefore the cost of interest and the effects of inflation are going to be significant, that needs to be what's called a discounted cash flow that takes into account those changes. And we have a video answering the question, what is a discounted cash flow, that you can watch. And of course, once you've got your cash flow and your budget, you've got the basis for building your business case. Because your business case is nothing more than a comparison between all of the costs that you've just estimated and all of the benefits, which is a whole separate exercise. Take a look at our videos on business case for more information. So cost estimating. It's uncertain, it is difficult, but there are tools and techniques to help you. Understand the different elements that go into your estimate and the different approaches you can take, and you will be able to produce a reliable estimate for your project. Everyone is feeling the rising cost of doing business. I'm feeling it in my business, and I'm sure you're feeling it in yours, and that is affecting our ability as project managers to get the job done. So the question I want to look at is, how do you respond to the pressure to reduce your project budget? Exchange rates are volatile, which means imported goods are becoming more expensive and there's a pressure to discount exported goods. Too many companies are finding themselves under huge budgetary pressure, and that is driving budget pressures on all projects too. Fuel prices are increasing too, and for companies not in the US who are reliant on US-built software and technology, their prices are rising too as the dollar strengthens. All this is putting huge pressure on project budgets. Resources will diminish and scrutiny will strengthen, and the penalties for cost overruns will rise. And with it will come blame and recrimination. So what does this mean for you as a project manager? Well, as soon as I hear the word cost, 3 other words come to my mind: time, quality, and scope. And as a project manager, if you need to reduce your cost, then it pays to understand the 3 levers that you have of quality, time, and scope. To reduce the budget, one solution is sometimes to reduce time pressure. Now, it's not always true that if you take longer to do a project, it will reduce the cost, but the opposite is true. If you want to speed up a project and deliver it more quickly, then you are going to have to incur greater levels of cost. So it is sometimes the case that by adjusting your schedule, you can reduce costs. So that's option number 1. Option number 2 is to reduce the quality specification. This will always work, of course, if you work to a lower quality and you are prepared to accept a reduced product, then that will reduce the cost. But in return, you will, of course, have to deal with the possibility of reputational costs. But this is where value engineering comes in. Value engineering is all about reworking the product or service proposition so that it gives a higher value, a better balance of cost and benefit from the product. And sometimes by relooking at the way you do things, you can reduce the cost. Now, it's very rarely the case that you can reduce the cost and maintain all of the quality, but sometimes a small reduction in quality can have a disproportionately large reduction in cost. So, reducing quality is option number 2. If you can't deliver any later nor work to lower standards, then option number 3 is to reduce the scope of your ambition, to aim to do less, to look at the full scope of your project and ask yourself, what elements of that scope deliver the least benefit? If I were to trim some elements of scope from my project and do less, could I deliver a disproportionate amount of benefit and save myself a substantial amount of cost? And often that's the case because scope tends to work on the Pareto principle. You get 80% of benefit from 20% of the scope, which means that if you were to trim some of the scope, you may not find a substantial reduction in benefit. And you could continue to deliver that at the same quality standard that you originally planned to do. To do this will certainly require some difficult conversations. You're going to have to meet again with your stakeholders and push some of their musts down to shoulds and some of their shoulds down to coulds in your Moscow analysis. But if you work hard and you negotiate hard with your stakeholders, it's often possible to find things that you can either not deliver on your project or promise for a subsequent phase of the project, which might receive a new budget allocation, perhaps when money gets somewhat less tight. So, when your client or your boss or your project sponsor says, we need to save money, we need to reduce the budget, you don't need to make a belligerent no, can't do that response, because for a project manager, saying no is anathema. It's not what we like to do. We like to say yes. And you can say yes if you say yes if. Yes if we're prepared to reduce the standards to which we work. Yes if we're prepared to deliver a little more slowly and a little later. Yes if we're prepared to deliver a little less to reduce our scope. And remember, there's always the option to trade contingency from your budget for an additional acceptance of risk. This should never be your default, because taking on more risk for your project needs sign-off at a senior level. But as a project manager, you need to avoid the words "we can't" and to replace them with the words "oh yes, we can if." As a project manager, you need to anticipate future budgetary challenges. Why is this an issue? Why does it matter? Because shift happens. Things change. And if you're not able to anticipate those shifts, then your response will always be reactive. But as a project manager, your job is to be in control. And being in control means anticipating what's going to happen and acting to avert it, or at least responding to it quickly and effectively. You need to act before you lose control, and that means constant horizon scanning, just like a meerkat. You need to get up on your hind legs from time to time and look out to the horizon and see everything that is coming. And that way, you can anticipate budget challenges. If you do your meerkat routine properly, you will spot future budget challenges on the horizon. So, what are you looking for? How can you spot it? And how should you respond? we'll answer each of those 3 questions in turn. And the first one is, what are you looking for? I think there are 6 major causes of challenges to your budget. And the first one, of course, is changing requirements. Stakeholders want something different to what you'd originally planned around. Secondly, new stakeholders emerge with their own requirements. It may not be completely new stakeholders, but stakeholders you were either unaware of or chose not to engage with fully. And so you're learning new things from people that you hadn't learned from before. Next is the obvious one, changes in prices, which can happen due to inflation, foreign exchange rates, interest rate changes, and even a number of other factors. If prices start to shift, then that will create a budget challenge, unless you're lucky enough that the shifts are in your favour. Fourth is when you identify new risks. Someone on the team spots something that could happen that you hadn't thought of before. And of course, the natural one to follow on from that is issues. Something does happen. There's an accident, there's a mistake, there's an error, there is a failure somewhere, and you have to put it right. And of course, that takes resources. Resources cost money, and that can challenge your budget. And finally, let's face it, human error. You may have misestimated your budget. Or, under political pressure, you were compelled to put in a smaller budget than you really need. As soon as you become aware that this is critical, you need to act. So if those are the causes of budget shift, how can you spot them? Well, you're looking for leading indicators. And some examples of those are monitoring expenditure against plan, use of earned value, we have a video on that, formal reviews of your risk register, monitoring the quality of the deliverables you're producing. If you see they take a dip, then it's going to cost money to fix it. And also monitoring change requests. If you have a formal change request process or even an informal one, then you need to keep an eye on all of the requests that come in and see if they are more than you had anticipated and therefore likely to have an impact on your budget. Monitoring the performance of your team members, of your consultants, your contractors, your suppliers, everyone in the project. And keeping an ear to the ground, sensing the mood of your stakeholders. Is something rumbling up that you're going to have to deal with that is going to cost money? And of course, speak to your team members too. Listen to their concerns. Often they're aware of things earlier. And of course, if you speak to them regularly, you can get clued in quickly. And finally, tracking the costs of any raw materials or assets you need to use. And if appropriate, keeping an eye on exchange rates and interest rates. So, you've spotted a challenge to your budget. What can you do to deal with budget challenges? Well, as you might expect, it all comes down to the classic 4 constraints: time, cost, quality, and scope. The choices are, firstly, to secure extra funding for your budget, that's cost, to adjust your schedule, that's time, to look critically at whether you can adjust the quality, this is sometimes known as value engineering, or to reduce the scope of your ambition for the project, to do less. Of course, you can re-engineer the whole project, look at whole new ways of doing things, or possibly even produce a variant product. This is value engineering at its extreme, and we do have a video on value engineering if you're interested in that. However, be aware if you go to that length, then it is likely that you will not only impact on the cost of the product, but also the benefits that you can achieve from it. And if your project was predicated on a benefits case or a business case with a certain value and a certain cost, then you may need to revisit the business case or the project proposal or the investment appraisal that you made. However, when budget challenges come, keep a level head and remember the time, cost, quality, scope, 4-way constraint. Please do give us a thumbs up if you've liked this video. There's loads more great project management content in the works. So subscribe to the channel and hit the notification bell so you don't miss any of it. And I'll look forward to seeing you in the next one.